Hey guys, it's Philip and Bob here at Trade Genius. Look, this is a really important podcast because things developed overnight with the banks and one bank in particular. And if you haven't heard of SVB Bank, you're probably going to want to pay attention because it's probably going to be like our new Lehman or Bear Stearns of this cycle. And it's got a lot of ramifications. We're going to get into what's going on and what it means for people. So stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Okay, Bob. So, another pretty red day. Nothing like super tragic, but it's just going down, down, down day after day now. So, and now we've got this banking problem, and I think you can do a really good job of explaining to the folks exactly what's going on here. So,
yeah, you ever see that Men in Black, movie when the guy says, "Am I looking scary enough?" and he pulls his teeth back and his eyes out?
Yeah,
that's probably how we're going to be by the time this thing is ending. So, what's happening with the banks is really fascinating. It's a different way for them to go bankrupt. So during the pandemic, a lot of money was thrown, and we've been talking about that forever. A lot of money was thrown into the economy, more than what was needed. So people and businesses were putting this excess cash into the banks. Well, the banks were choking on all this cash, didn't know what to do with it. They were already over reserved. They threw a lot of that reserve in with the Fed, to collect that free money that the Fed was giving out. The Fed was raising that rate so they wouldn't lend it out. But then these guys also turned around and they bought mortgage-backed securities and they bought treasuries. In and of itself, smart, right? Because those two are the lowest rung of risk in the United States in terms of, tier one assets. The problem is that they believed the Fed, their first mistake, when he kept saying lower for longer. So these guys bought all these assets, Phil, at the top. That means they're buying mortgage-backed bonds at 1.5% and 2%. They're buying 10-year, 30-year treasuries at 1.5% and 2%. And then what happened over the next 18 months here is that we've gone from zero rates to now we're pushing up to 5% money. And in and of itself, that's not a bad problem for the banks because they have it in a category called held till maturity. You're going to see that a lot. So HTM. And so they just hold it, collect they're basically coupon clipping. But another problem happened along the way is that the depositors are saying, hey, you're not paying me anything for my extra money. So why should I give it to you? I could put it into money market accounts, or I can move it into my brokerage account, get a money market account, or I can go ahead and actually buy T-bills with it and get 4.5% and 5%. So the deposits started to collapse at these banks. At the same time, and especially with this bank called Silicon Valley Bank, is their customers were also drawing down their cash. And so their deposits starting to fall. Well, they have to get their reserves back, their ratios back in alignment. So normally what they would do is they would sell their non-cash assets and basically reallocate. The problem is that when you have a bond that you bought at 1% and you got to sell it at 5%, you're taking a haircut on the bond. And remember in 2008, for those of you who weren't too young for this, is that they changed the rules for recording asset values that you wouldn't have to change it other than the price you paid for it until there was a material event that can't be rectified by time, i.e. the borrower stopped paying, or in this case, you needed to sell it. And so they had to sell this stuff at a loss. Well, they just did an earnings report. They reported a 15% loss on their portfolio, and they reported their deposits were down. Well, this was like lighting a match on a long fuse, and then lo and behold, I think on Wednesday, the light hit the fuse, hit the powder, and boom, this thing was down 87%. And then overnight, the FDIC took it over. And so this isn't the only bank that has this problem. They all did this, Phil. And so they're all what's called mismatched. And this is supposed to be where the Federal Reserve is supposed to actually come to the rescue. They should have been able to push those bonds onto the Federal Reserve's balance sheet, except the Federal Reserve is QTing. They're not taking these bonds. So these banks are blowing up. And this is the first. There's another one called something bank in New York. I forget it is. And then there's another one out there. But it's a problem. So that's the explanation behind it. It's a different way for these banks to lose money. And the irony of ironies is that the Federal Reserve put their bazooka on the middle class and the bankers walked in front of the rocket. And check out this chart, Phil, on the what the carnage looked like today in the banking world.
Yeah, I mean, like, I know it's hard to read, but SVB is at the top of the list, minus 46% today. PacWest Bancorp, minus 19. First Republic Bank, minus 15. And then the list goes on, and they get a little bit, the declines are less as you go down. But I mean, every bank just about it, they're just getting clubbed today.
Yeah, and it's a problem. And so if we could flip to the next slide, this is where the problem starts compounding, guys, is that the U.S. banks have $17.6 trillion in deposits, okay? Only $3.1 trillion is backed by cash. That means they have a ratio of 20-to-1 leverage, okay? And only $100 billion of that cash is cash. Okay. Remember, the other part is digital cash. And so it doesn't take much for a bank run. And what we're telling you guys is here's a mantra of trading. He who panics first panics best. So I would get money out just so you have some walking around money and cash in case these idiots overextend themselves and we start having bank holidays here. Because look, I don't trust this group. Janet Yellen, she's an absolute moron. She's just a propagandist trading as a banker, right? And I don't think these guys really realize how scared people are and how the economy is on such an edge. And I think people should start pulling cash. Yep. And protect yourself and save that cash for when you have to go to a grocery store and actually buy something because they may not take your debit card. And I'm not trying to scare the children here. Forewarned is forearmed in this situation. So enough said on that. So 20-to-1 leverage. The European banks are leveraged 50-to-1, Phil. So basically a sneeze and a hiccup puts those guys out. In fact, Credit Suisse didn't report because they were in violation of an SEC report. So they're screwed too. Deutsche Bank, Credit Suisse, all these terrorism banks of Europe, just like Asia had, HSBC Bank and Barclays. Remember those guys when they had their issues, Phil? So I think this is setting up like another Bear Stearns.
Right.
But let's not get ahead of ourselves. Let me show you the next chart because this is saying, look, this is confirming to everybody that recessions come. Banks are canaries in the coal mine, especially these small banks. They don't have the reserves. They don't have the backing. They don't have the collateral. And so they're the first to blow up, okay? And these guys aren't even leveraged. They're just wrongly positioned. That's scary in and of itself. And so recession is coming. And then I'm going to take a breath here, Phil, and I think this is really interesting. Phil's going to read this word for word for you guys, because this is the scariest thing yet. This is the knock-on effect on the economy. And I'm not talking about lending. I'm talking about economic survival. And here it comes. Phil, I'm going to throw it back to you.
Yeah, so I'll put up this slide. I'll read it off to you guys that are just listening in. Okay, and to preface this is from an analyst from the banking system, okay, trying to figure out what the collateral effects are going to be on this, right, or the systemic risks. And I also had somebody who contacted FDIC, and some of this that they're stating in here, I can correlate as true. So a lot of these guys are going to be left with an IOU coupon. Okay, so there's going to be hundreds of millions, if not billions of dollars that are out of circulation right now until they can figure out what's what. So let's dive into what they said. So it starts off, SVB, that's the banking question here, was not just a dominant player in tech, but were highly integrated in some non-traditional ways. A few things we'll see in the coming days and weeks. Okay, this is important. 1, SVB was incredibly integrated into the lives of many founders, not just their startup's bank and lender, but also provided personal mortgages and other financial services. A whole mess for FDIC or the eventual buyer to unwind. 2, any uninsured balances at SVB, which is those above $250,000, are in jeopardy. FDIC plans to pay them out as it sells the assets of SVB. Lots of startups exclusively banked with SVB as this was a covenant of their debt. So again, all that money is now instantly locked up. Okay, that's important going forward here. CEOs yesterday faced a hard choice. You either pull your deposit and go into default on your venture debt or risk losing everything if the bank failed. Many chose to hold tight as SVB's outright failure seemed outlandish. Now they may not be able to make payroll next week. Unpaid wages pierce the corporate veil, so boards are incredibly sensitive to employing workers they may not be able to pay. Expect mass layoffs either starting today, Friday, or Monday at the latest. And given the weak fundraising environment, a number of startups have been reliant on venture lenders like SVB not aggressively pursuing amortization of debt or triggering default for covenant footfalls, i.e., cash balances. So how is the FDIC going to handle this? Is it going to be just mass defaults? So that's the end of the message. So this is a catalyst for big systemic risks going into next week, and watch what happens over the weekend. I'm going to say keep an eye on Bitcoin, because a lot of times if we're going to gap down, Bitcoin will start heading lower over the weekend. So that's one indicator you could use to maybe expect that we see some red next week. I know already, Bob, you were saying the technicals on the option flows were pointing to a red open on Monday.
Yeah, absolutely. So we have an indicator that's highly reliable. It's not mine, it's not ours. It's one we use that is highly predictive for the next day, whether we're going to be opening red or green. And it was getting more decidedly red every day. Plus Friday down, Monday down, going into OPEX week. Usually Friday down, Monday down, Tuesday down. So expect some redness there in the markets. And we saw nothing to tell us that there's hope. We heard there's a Fed emergency meeting on Monday.
Yep.
So we're going to start getting these rumor control things. So it's going to be a tough market to trade, actually. It's going to be see profit, take profit, and be pissed off because you didn't make more money when it keeps falling. But that's okay, because in 2008, they took people's heads off with these news announcements. So you're just going to have to be a squirrel with a nut and be happy. You know, you didn't get the whole tree, but you don't starve to death. The thing, though, about Silicon Valley Bank, Phil, that really annoys me is that the CEO yesterday and the day before begged those people, those businesses, to not pull their deposits because this is going to all blow over. And so now, you know, his comment probably swayed a lot of businesses not to do anything, you know, because they trusted in him and his leadership, and now they're gone.
Yep.
And yeah, this knock-on effect, this is scary. And look, and this happened in 2008. I owned another business that we were moving a lot of equipment around. And you did too, Phil. You were in a business that you guys were on the hook for a lot of equipment. And we were just telling people, you know, only pay us exactly when you need to. You know, we're lining up payments right away because we didn't want to have any extra money in the bank because we just didn't know what was going to happen. And people that payrolls, that's the thing is, if you have over $250,000, you know, I mean, that's a nothing burger for a company for payroll. So
Right.
This is really scary stuff. And when this all settles down, every company that's not profitable today or at a cash flow basis, Phil, that have to rewrite their loans or they're going to have to dilute their shares, these haircuts are going to be brutal.
Yeah.
So this is what we're talking about. This isn't just going to be a quick V down and up like 2020. This is going to be more like an L, you know, like Smash Mouth. Okay.
Yeah.
That's what it's going to be like for a lot of these companies. So be careful out there. And here, Phil and I thought, hey, we're probably done with the doom. And then the banks go ahead and they give us another topic to discuss. But this is serious stuff. This is no
really
longer
is.
playground trading now. Now things are going to get real because it's going to affect Main Street very directly.
Yep. Well, we had a couple of videos in the past too about, you know, banks that lie and you know, banks are in big trouble because of their liabilities. And here we go. Here's the first one pop into the surface. So I know we report on some negative things, but it's not, you know, it's not just because, you know, it's based in facts. And unfortunately, it's rearing its ugly head. But those of you that I see in the comments, you guys have been listening and you guys have been hedging to the short side and you guys are doing okay. And today you probably did better than the comments I saw yesterday. So good on you. We still don't think it's over. Some things are getting a little oversold, but we can still drop another 100, 200 points in the SPX still and not get into like real critical mass territory where a big rip is imminent. So our position is that we still probably got more downside before any relief comes anyway.
Yeah, and thanks for reading it out, Phil. I think it's important for people to understand. And guys, hit like, hit subscribe, notification, share this video. You tell your friends. Look, we want everybody here to survive and thrive during this time period. And look, even in 2008, when these markets would have these wild swing down, you can make really good money on the upswings too. So this actually is going to become an environment where the tools that we have should be very effective in helping you guys, just basically stay out of the big mistakes. Yep. Not that we're all going to make a bunch of little mistakes because they're going to be unavoidable, but we're going to keep you out of the alligator lakes, okay? And, try to keep you out of trouble.
Absolutely. All right, guys, thanks for watching. Please hit like and subscribe and smash that notification bell. If you can set it to all, that would be awesome. And we'll catch you on tomorrow's video. Take care.
Trade Genius.